We good?
We're good.
Very good. Thank you, Grace. Everybody, this is Alex Sylvia with NuView Trust Company. And today we've got another installment of our weekly workshop. And today we've got a very special guest. This is actually was one of our speakers at our inaugural annual investor retreat that we held back in the beginning of January of this year. And her name is Dawn Pitts. She's from Ignite Funding. And she's coming to us today to talk a little bit about trust deeds all the way from A to Z. It's going to be an interesting topic. I'm excited for it because I'm a new investor myself. I know the IRA side of things really well, but when it comes to unique asset classes and what the strategies look like, what the due diligence looks like, I'm learning just like you. So we're definitely going to have some fun today. We'll get some questions in at the end for Dawn. If you guys have any questions along the way, definitely put them into the chat box or the Q&A section in Zoom. Put them as a comment on Facebook, wherever you've got them, and we'll be sure to get some of those answered. So before we get into Dawn's presentation, I do want to cover a couple important slides, stuff that's a little bit about NuView, a little bit about self-directed IRAs, just some general information for those of you that might not be NuView clients yet and are looking to get started. So what is a self-directed IRA? A self-directed IRA is actually no different than an IRA that you would get at a Charles Schwab, a Fidelity, TD Ameritrade, any of the others. The main difference in self-direction, true self-direction, is in the custodian themselves. Those other companies, they've got packaged products, mutual funds, other things that they want to recommend to you, to sell to you, and they'll make commissions off of those. At NuView, you're the entrepreneur, you're the investor. We provide you the tax sheltered investment vehicle and you find your own investments, you do the due diligence on them, but we provide you with a way to get your retirement off of Wall Street and onto Main Street. And that's the true power of self-direction, is having the reins to your entire retirement, being in control, and possibly even investing in something that you already have an interest in or a skill set in. Self-directed IRAs, you can invest in what you know best. And that's part of the benefits, right? So diversification, tax savings, just like any other IRA or tax sheltered retirement vehicle, and you can invest in what you know best. So to real estate investors out there, the lenders, people who know startup companies really well, it's time for you to take advantage of those skills that you have inside of a tax sheltered investment vehicle like an IRA, 401k, health savings account, or education savings account. And I said it already, but the diversification you get by using a self-directed IRA to invest in alternatives is like nothing you'll be able to get out of the stock market. On top of that, cash flowing assets like real estate and promissory notes, if you're lending, can really add such a boost to your compounding interest inside of your IRA. So imagine you're already free and clear of capital gains tax. You can reinvest that money on a yearly basis, which would have otherwise went as a check to Uncle Sam. And now you can also have cash flowing investments like real estate inside of an IRA, which oftentimes dwarfs what you might be able to get as far as dividends or interest yield from the stock market. A lot of power to be had in self-directing your tax sheltered investment vehicles. So at NuView Trust Company, we do have a few options for you, the self-directed investor. There's many different avenues that you can take to maximize your tax savings. At NuView, we've got 3 different categories of investment vehicles. Personal plans, first off, is your Roth IRA and your traditional IRA. And then we have our employer plans for self-employed people, and these include your solo 401k, your SEP IRA, and your simple IRA. And then you also have your special plans, your specialty plans, your can I have fries with that plans, and that is your health savings account and your education savings account. Those 2 are unique because you can actually use those now for qualified expenses and experience all the tax benefits of tax sheltered investment vehicles. Now, once you have those, what can you actually invest in using a self-directed IRA, 401k, HSA, or ESA? And the list is honestly endless. What we've got right here for you is really only scratching the surface. When it comes down to it, the IRS says your IRA, 401k, HSA, or ESA is restricted only from 2 investments, and those are life insurance contracts and collectibles. Anything else under the sun, if you can put a title to it, chances are it would be considered a valid investment for your IRA, 401k, HSA, or ESA. There are some rules you have to follow, right? You're getting rid of capital gains tax forever. So the trade-off is, oftentimes those funds have to stay in the account until retirement age, or in the case of the HSA and ESA, those funds have to be used for qualified expenses. But as far as the investment types, like I said, if you can put a title to it, your IRA can hold it. Whether or not it's a good investment is up to you, the self-directed investor, the entrepreneur, to find good investments to make, making sure that you're also not, creating any prohibited transactions, which are just some of the rules you have to follow with IRA investments. So there's certain people that your IRA can't do business with, some of which include your family members. Your family members might be beneficiaries of your IRA. So the IRS just really doesn't want any conflict of interest type situations going on there. So without further ado, now I'm getting a little bit long-winded. I do want to introduce Dawn Pitts. Like I said, she's from Ignite Funding. They specialize in trust deeds, and the way she explained it to me is they're a little bit of a one-stop shop, all-in-one agency fund that helps people invest their tax-sheltered retirement dollars or HSAs or ESAs into trust deeds, which, like I mentioned before, I don't know much about. So this is going to be a little bit of a journey for me, but I'm going to have some good questions for Dawn at the end. So Dawn, I hope you're ready for them. But other than that, without further ado, Dawn Pitts, if you want to introduce yourself and present, yeah, we'd love it.
Very good. Thank you, Alex. I appreciate that. And a lot of good information about the different types of IRAs that can be utilized to self-direct and to diversify your portfolio in different asset classes that provide you a steady fixed stream of income. Trust deeds being one of those. Trust deeds are basically an investment in a promissory note that's collateralized by real estate. So as an alternative to the stock market, it offers you that ability to have a real tangible asset versus the stock market where, it's so volatile that at times when a company might find itself in bankruptcy, you become a general shareholder and those are the last to get paid back. So just kind of going through here, talk a little bit about who Ignite Funding is. So Ignite Funding is a commercial mortgage broker. We actually originated way back in 1995. We're not new kids on the block. This isn't just some startup overnight type of investment that, the IRS just happened to approve. We have been in business for a long time. We started out as a residential mortgage broker back in 1995, and investors funded residential mortgages that were short-term notes before they would get sold off to, conventional lending facilities, Fannie Mae, Freddie Mac. But in 2011, we found that it was a better fit for our investors to start funding loans that were commercial loans. And so we started working with builders, developers, land acquisition companies, commercial rehabbers that would buy commercial real estate, maybe tenants in tow. They're going to continue leasing up space, doing tenant improvements. And then once it was fully leased, they would season the rents and flip those to either a REIT or a fund that wanted steady fixed income from a commercial piece of real estate. So all of our operations that are in-house, we do everything like Alex had alluded to. I said, we're A to Z. We are. We originate, we fund, we service the loans. And if for any reason there's challenges with the borrower not being able to make his interest payments or to pay the loan off when the maturity date comes due, we're going to be the company that resolves that default. And once we've resolved the default, either working with the borrower or by taking the property back through foreclosure, we're going to be the company that also sells that piece of property. And so we don't outsource any piece of this transaction anywhere, because who knows that property better than the company that underwrote it and the borrower. We know the borrower better than anybody because we've done all that vetting and working with him through the projects that we've funded. We offer double-digit returns because obviously that's what investors are looking for. They want to see double-digit returns. And because we're charging the borrower hard money lending, it's double-digit rates of interest to the borrower on these short-term notes, we can pass on 10 to 12% to the investors. one of the things that sets us apart from a lot of other companies, I call us a boutique type of hard money lender. One of the things that sets us apart is on our website, we are just so transparent. We put on our website our complete performance history. So every loan we've ever funded is under our performance records annually, and you can see the performance of that note. We've funded right now about 1.2 billion in loans, and that represents about 90 million in interest that's been paid to our investors. That interest is paid monthly. It is taxed on a 1099 form, 1099 INT, which is ordinary income. But if it's done within your self-directed IRA, of course, it's growing tax-free or tax-deferred, depending upon what type of IRA you're utilizing. The asset management performance record, less than 3% of our loans have gone into default. So those that we have resolved and the ones that we're currently working on resolving show up on our website under our asset performance record. So people can see exactly what we've done with the performance of that loan, even if it falls into a default situation. So what is it that you're really investing in, right? You're investing in a note. So this is a performing note collateralized with the deed of trust, the promissory note, the title policy that puts our investors in a first lien position fractionally. So minimum investment is $10,000, very small barrier to entry. But we do that strategically. That allows investors to diversify their portfolio within the asset class of trust deeds. So, you have maybe $100,000 you want to allocate to trust deed investing. You can invest in 4 different borrowers, 25,000 a piece, 4 different types of loans. We have 26 different borrowers, 5 to 6 different types of loans. And we have funded across the United States in about 22 different states. We primarily try to stay in trust deed states instead of mortgage states. A lot easier to take a property back in a trust deed state if we have to. So we focus on those states that are trust deed states, but that offers a lot of diversification. Now, we take what I call a 3-prong approach to producing these investments. First of all, Ignite Funding is the commercial mortgage broker. We're the ones that are underwriting, we're funding, we're servicing, we're resolving. But without the borrower coming to us looking for loans for either land acquisition, development, or vertical construction, if they didn't come to us, we wouldn't have anything to offer to the investors. And if we didn't have investors looking for projects that they could fund, none of this would work. So we have to have all 3 of us. We serve as the middleman that does all the legal paperwork, all the underwriting, and making sure that on that deed of trust and title policy, you are listed as a benefactor in the first lien position. Those are your instruments that collateralize you on that piece of property. And so we take care of handling all of that. The processing, the servicing, everything is done within our staff here at Ignite Funding. Borrowers that we work with, these borrowers come to us every day. Our underwriting department is being reached out to by email, by phone, through our website. They're looking for funding for their projects. So what we're looking for is established residential home builders or commercial developers. We want them to have a proven track record and that we can look back and see the history of their company and what they've done, and that they've been successful in producing and fulfilling their goals to build, develop, renovate, whatever it is that they've come to us for funding for. So we like to see that they have at least a 10-year or more years of experience in that field that they're building or developing in real estate. They also, the majority of them that come to us have their own banking relationships. So it's not like, I think a lot of times people get confused when they hear hard money lending and they say, oh, that's because that borrower can't get funding anywhere else because his credit's bad, or he's a super risk. Let's not look at anything in hard money lending. That's not necessarily true. The borrowers that we work with have relationships with other lenders. They work with their banks and other credit facilities. We are an addition to that. So a lot of the borrowers that we work with, they're either too small for big banks to lend down to, or they're too large for small banks to lend up to. So there's a gap in there. That's the niche that we have always found our borrowers in. And so sometimes we grow these borrowers right out of Ignite funding because they get to a point where all their relationships then come from conventional lenders. And other times we will build those companies and then they'll continue to utilize us for that short-term gap financing, just-in-time financing, because with the pool of investors that we have, we can fund these loans very, very quickly. Sometimes, we'll get a loan out on the floor at 9 o'clock in the morning, and it could be filled by 11 with investors that want into that particular project, and we'll be closing and funding through the title company by the end of the week. That's quick financing. Banks can't do that. And so the borrowers will come to us for that specific reason and utilize us for that short-term financing. Another reason they'll come to us is because, banks don't like to lend on raw land. They don't like to lend sometimes on the development of land. They'll be more than happy to lend on construction. But if you can't get from A to C, what good is it going to do you? So they need it. They need us, and they'll pay that higher rate of return. But we're looking for long-term relationships with our borrowers. So you will see on our website, if you look under funded investments or available investments, you're going to see that we have some of the same borrowers over and over and over again that we're funding loans for. We fund loans for a company up in Colorado called Local Homes. Local Homes and Gray's Development, those are two companies that work hand in hand with each other. And you'll see a number of loans that we've done for that company since 2015, I believe. And they're building communities, townhome communities, apartment communities, single family home communities. And we'll be funding several projects throughout the year for that borrower. Same thing with a company called GGD Oakdale or Rhino Investments. He's a commercial borrower that does renovations of strip malls. We have done over 40 projects for Sanjeev Chopra, and those are all across the United States. And so that long-term relationship that we're looking for with a borrower also provides some comfort and confidence in investing in trust deeds for our investors. They get used to those borrowers and they want to continue lending to specific ones that they've been working with year over year. So when you're making an investment, or when we're funding a loan, we're going to be funding a loan that's either land acquisition, land development. It could be vertical construction of apartments, multifamily apartments, townhomes, residential single family homes, or it could be assisted living facilities, storage facilities. There's a number of different types of loans in construction that we'll work with a borrower on. Some of these could be luxury homes that we're funding to be built. Blue Heron is one of our builders here in Las Vegas that builds residential homes, and they're luxury, high-end luxury homes. So that offers a little bit of diversification for our investors to be funding, just single family homes that are more in a median price range, all the way up to the luxury homes. And then of course, the commercial loans that we fund. And those are usually on acquisition of commercial real estate where there's tenants already in place, and they're going to continue leasing those spaces up. Like I said, we lend in about 22 different states. I've bullet pointed here the main states that you'll find us in. And this changes too. So you might see that we lent up in Seattle and Portland, Oregon in the last year, but that might not be where we're lending currently, looking to fund loans in that specific area. What we continuously do is watch the market drivers that drive an economic community, drive the community economically. So what are the market drivers? Well, they're going to be, jobs. Are there jobs in that area? Is there growth in the population? Is it a desirable place to live? Is it affordable? Those things we're constantly keeping a thumb pulse on in every area that we're looking to lend in, because what causes a market downturn? It's when there aren't those market drivers there. And so we always are looking and keeping a good thumb pulse on every area that we're lending in to ensure that our investors are stepping into the water, not at the peak going into a downturn, but on that upswing. So there's 3 cycles in real estate, as most investors that are investing in real estate know. That's the boom, the slump, and the recovery. And every state across the United States, the time frame in between each one of those cycles is different. And so we want to keep a good thumb pulse on what's going on in each state that we're going to be lending in, so we can pull out of that state if it looks like they're starting to have a market downturn. We don't get caught up in the slide backwards. So in every investment that you go into, it doesn't matter what it is, whether it's stock market, whether it's tax liens, oil and gas, there's a risk versus a reward. And if you understand the risk versus the reward in every investment that you go into, you can help yourself to minimize the risk, right? And then participate in the benefit without getting yourself caught up in a downturn. So the risks in these investments, really, there's one major risk. You're going to find yourself in a default, right? But the benefit, obviously, is you're getting a 10 to 12% annualized rate of return, which you can't get in most other investments. So when we're looking at the risk itself, being that at the end of the day, if a borrower defaults, you are 100% going to become an owner of a piece of property, a shared owner of a piece of property. What are you really losing? So if there's going to be any loss, it isn't going to be realized until that property is actually sold. But do you have to sell it? Can you hold on to that piece of property if there's a market downturn? Hold on to that property, wait for the market to go back up, and then sell, and end up breaking even or even having capital gains on the back end? That's definitely a possibility. And so the investors themselves are the ones that determine what we're going to do with that piece of property should it go into default. So we ballot the investors throughout the process. 51% majority is the direction that we move in. Of course, as a company that is extremely transparent, we want to make sure that when we are working with our investors and communicating to our investors through a default, that we give them enough education and information for them to make the best decision for themselves and that resolve on that piece of property. So when we ballot the investors, we usually give them a couple of different options. Here's your option. We either file a notice of default and get the time clock ticking towards foreclosure, or we sit and wait, and hopefully this borrower will bring that loan current. Well, the best resolve is get the time clock ticking. Doesn't mean we're taking the property back yet. It just puts him on notice. And so through our office, we have customer service representatives as well as business development executives like myself that will educate the investors through that process so that you know what's happening and why with that piece of property if it should fall into a default status. But as far as benefits go, that high yield, the short-term loans, so that you can get in, get out within 9 months to 27 months. The passive income that's fixed, the experience of the borrowers, and the diversification, those things coupled together give investors a greater benefit than what the risk actually is. Like I said, less than 3% of the loans that we have go into default, so default rate extremely low, and compared to 1.2 billion in loans funded. I believe it equates to about 43 million of properties that we've taken back. We have sold and disposition, returned capital back to the investors, about 40 million to date. And so that leaves about 3 million that we're still working through, and we ballot those investors throughout the process. They tell us what they want us to do with that piece of property should we have an offer that's presented, and we're going to move in the direction that our investors have given us the 51% majority to move in. So kind of gone over a little bit of this through the previous slides. What happens if the borrower stops paying? Well, one of the things that we want to make sure we do is maintain the integrity of that piece of property. So Ignite Funding has in the past, and we intend to in the future, we have always put up the costs to maintaining that property out of our own capital. We haven't done a capital call to date to our investors, even though it does state in our loan servicing agreement within your investment documents that we could, and we could do a capital call. But we figure if we've underwritten that property well enough, and we've underwritten it at a 70% loan to value or below, there's that built-in equity there that allows us to put the costs out up front, but still recoup them through the sale of the property. So, we might work with a borrower on a joint venture partnership, or another company that will do a joint venture partnership in order for us to get the property in a position where, or a condition where we would be able to get it sold for the investors. All throughout that process, we are updating and communicating to the investors. That comes in the form of either a phone call, which we're very, very big on. That's why we added an entire customer service department to be in communication, not just through a default, but on a monthly basis to our investors to answer any questions that they have, so that they can feel that comfort and ease of making investments in trust deeds. I think education is probably the biggest confidence builder for an investor who wants to get into short-term notes like this. But we update through phone calls, emails, and then we establish a portal where we call it the default portal. Any investor that finds themselves on a default would have a username and password to be able to get into that portal and see all the updates. When we filed a notice of default, click the link, the paperwork's there. We're very much in communication with our investors throughout that process. We market the property for sale once we take that property back. And then, of course, when the sale occurs, we're balloting the investors for the approval when we receive offers. If it's 100% return of principal or more, we really don't need to ballot the investors. You're going to be happy with making sure you get all your capital back. So we wouldn't be balloting at that point in time. So let's talk a little bit about strategies, though. In the seminars that I've done in the past, I find that one of the best things to really look at is diversification. And, a lot of people will look at going into tax liens, or, they want to buy rental properties, and they sink everything they have into one asset class in one state. And the strategy behind Ignite Funding is to really diversify your portfolio. So at Ignite Funding, we're never going to say to a client, you should put everything you have in trust deeds. Absolutely irresponsible of any business development executive that would tell you you should do that. So I'm not going to tell you that. Should you be in the stock market? Sure, there's a place for some of your funds to be invested in the stock market, into maybe some funds, crypto, precious metals, rental real estate. I personally have, quite a few short-term rentals down in the Daytona area, some condos on A1A, right, oceanfront. I rent those short-term. And then I have rental properties in North Dakota. Don't ask me why I would go in North Dakota, but it was quite the adventure. But I have long-term rental properties in North Dakota, in Iowa, in Florida. That gives me some diversification because I'm not in the same state with every piece of rental property that I have. And I've done fix and flips as well. I find that in trust deeds, I have a steady, fixed, passive income. I don't really have to worry about the performance because I understand the process of trust deeds and how the underwriting is done. And I'm looking from the inside out. Of course, you're going to say, well, you work for the company, you're looking from the inside out. You're absolutely right. And that's why I love to communicate with new clients what I know and what I see from the inside of this company and how these projects are brought to our clients, why we underwrite the way that we do, why we would fund a particular project for a borrower. Last thing we want to see is a default. So we want to minimize the risk to the investors before we fund that loan. And so there's a lot of things that we do behind the scenes that we are processing through in an effort to minimize that risk before the loan's funded, being proactive rather than reactive. Should a borrower, default, then, we kind of know what to expect. We've already been, looking for when we're funding the loan, we're looking at, gosh, could we find a buyer for this piece of property? It's not swampland in Florida. It's not desert in Nevada. Is there an identifiable buyer that we could go to if we had to take this property back? Those are kind of the things that we look at before we even bring this to our investors. And so with that, it gives us that diversification model and a strategy of being able to have several different types of investments within your self-directed IRA or your cash funds. Getting started is probably the easiest step and the best step you'll ever take for your IRA or your cash funds. We offer the ability for investors to step into the waters, like I said, with a minimum of $10,000, but they can also step into the waters with non-qualified cash funds. So you can open an account that is a cash account, either joint or individual. It could be a business account. We have a number of businesses, whether they're LLCs or corporations that invest here. And it could also be a trust. I personally invest here at Ignite Funding through our family trust that we established. So that seems to appeal to a lot of people for protection, asset protection. You can also open an IRA account. And like Alex had mentioned in the very beginning, if it's a Roth, a traditional, a simple, a SEP, a 401k, it doesn't matter to us. If you want to use those funds from that self-directed platform, we'll facilitate helping you get that account opened up. So it's, you're going to gather a little bit of documentation, fill out an investor application. I think it's 4 pages. You can do that online, or I can send that application out to you. Once that account is established, then I'll send you investment options that are available at the time. These fill up quite quickly. So sometimes, I could send you a spec sheet, and by the time you're available to talk with me about it, it could be sold out. But we always have loans that we're in underwriting through the process. And so we try to keep loans out on our docket anywhere, between 3 and 6 loans at a time. And that could be up to 20 million in loans that we're filling at any given time throughout the month. When they fill up, our underwriting department's going to be pushing to get the next ones out for us to present to the investors. Once you choose an investment, then there's going to be electronic documents that you'll sign. I can go over those. I usually go over the first set individually with my clients so they know what they're signing and why. And once that set of investment documents is completed, there's a special power of attorney page that you would have signed and notarized and send back to me. That's probably the most important piece of the entire transaction. That special power of attorney page gives us the ability to put you on the title and then remove you from the title when the borrower is paying the loan off without having to round up, maybe 50 to 100 investors on a loan at the time that he's paying the loan off. It also gives us the ability to act on your behalf with anything pertaining to that piece of property because you are the first lien holder. So, and then the final step is to send your funds. And if you're investing through your self-directed IRA with NuView or any other self-directed custodian out there, we would process that paperwork with your custodian and they would send us the funds directly to fund the investment. Whoop. Go back here. There we go. So that kind of concludes Trust Deeds 101. I know that's a lot of information thrown out at you, and Alex is going to be sending a video of this out. So if you do have any questions, you are more than welcome to reach out to me either by phone. My number's there. You can call on the 877 or directly to the 5957 number listed there, or email me. But definitely don't turn off your brain to an alternative investment that's offering you a passive income out of fear. Get the education that you need to make yourself feel comfortable. Step into the waters, try it. If it's not something that fits for your goals or your portfolio, fine. When it pays off, your funds go back to your account and you can go on your merry way. But I would say, as a first-time investor in trust deeds, really check this out. Get the background information, get your questions answered, and let's get you in an investment and earning steady fixed returns. Thank you.
Yeah, thank you so much, Dawn. You definitely got my wheels turning, and I do like how you finished up there. And I like I said, I got a lot of questions for you myself. We definitely had some come through the chat and the Q&A. So we'll get to those. I mean, apparently we've got some really experienced people in our attendance today because they're asking some questions I probably wouldn't even have thought of. But I'm gonna start out with my simple one. How is a trust deed in this structure of investment? How is it different than a quote unquote simple promissory note?
Well, you're collateralized on the property fractionally.
Okay.
So on a there is a promissory note. The promissory note from the borrower and Ignite Funding collateralizes the investors on that piece of property with the use of the deed of trust. So it is a promise. You are investing in a promissory note that's collateralized by the piece of property.
Okay, very good. And I know there's specific states that do trust deeds. Were those states, did they ever not do trust deeds? And then was there, what prompted their use in comparison to like mortgage states that don't do trust deeds?
Well, I think it's a matter of whether they're a judicial state or a non-judicial and how they process through their foreclosures. Were some states trust deed states before and now they're mortgage states? That's a good question because, I think it's just more or less how their judicial process is when processing through a foreclosure. Okay. We primarily focus on those states, though, that are trust deed states.
Of course, yeah. No, and just like I said, it was simple curiosity. But what I find really what really interesting about it too is how much more passive it is too, even than, somebody drafting their own note. Having Ignite as the servicer, or whatever company as a servicer. The IRS loves passive with IRAs, right?
Right.
Any instance of the IRA owner getting a little bit too involved or too hands-on with their IRA's investments, that investor might be risking, creating a prohibited transaction, and then, having their entire IRA forced distributed, taxed, and penalized. So I really love like what you guys do and how it's a, almost even more passive than notes. And notes are obviously, one of the most passive, but now having the servicing component in there is very, very cool, because it, again, makes it that much more passive. And I do just want to touch on one question really quick that we got from Sophie towards the end. She asked if we do any accreditation check for the companies presenting. As we always say to our investors, we're not financial advisors. We don't give tax, legal, or investment advice. Like I said, Dawn was a speaker at our annual investor retreat, so she's an educator just like we are. So we always recommend our clients to do their own due diligence. We're not going to say, yes, go invest with Dawn and Ignite Funding. And that's not to knock Dawn and Ignite Funding at all whatsoever. It's just, these are self-directed IRAs, people. We don't do that side of it. As the investor, as the entrepreneur, you're making these decisions yourself. You're doing your own due diligence. And, at the view that I see right now, Ignite is a great company with what they do, but we always throw up the disclaimer: it's a self-directed IRA. There's going to be some due diligence and some legwork on the investors end, on the clients end. And, as long as you give us your written authorization, we'll do whatever you want us to do with your self-directed IRA. Just make sure that you're doing your homework ahead of time and making sure that, the companies you work with are credible, and good people to work with. So, just like I said, just wanted to touch on that real quick.
No, that's a really good point. That's a really good point, because I've been with Ignite Funding for 13 years. June will be 13 years. And we are licensed. I'm licensed. We're regulated. We're overseen by the MLD. That's the Mortgage Lending Division of Nevada, and any other state that requires that we have licensing to fund loans in. And Nevada is one of the most stringent states where it comes to compliance regulations. And so if a state that we're lending in, their compliance is not at the standard that Nevada's is, we're still putting it up to that bar and staying within those. And if any other state that we go into, it has a higher bar than Nevada, we're going to raise the bar there. But we are licensed, we are regulated, but everybody should be doing due diligence on any company they're looking at investing in. I think one of the biggest things that I've seen over the years is, and because we work with a lot of custodians that self-direct IRAs, and one of the biggest things that I have seen over the years is peer-to-peer lending, that people don't do their due diligence, and they end up in notes that are either secured or unsecured, or that weren't they didn't do their due diligence. They didn't have everything in good order, and maybe the custodian didn't have everything in good order. And the next thing you know, they're having to distribute an asset that they don't even have anymore out of their IRA and pay the taxes on it, because they got into a note that was unsecured and they thought they were secured by it. And I mean, there's some pretty crazy stuff that goes on out there. So absolutely do your due diligence on whatever company you're looking at investing with. One of the things that I like to have my clients that are looking at investing in trust deeds do is, number one, check us out through the MLD. If we have had anybody within the company that has had any sanctions or restrictions, it's going to be noted. If there's been any felonies or anything, that's all disclosed to the investors. If we've had any fines, that's going to be disclosed to the investors. But also, I like to have my clients go to the Better Business Bureau. And I know, some people say, oh, that's Better Business Bureau. They just let all these reviews come through and they don't really check them out. Not true, at least not here in Nevada. So when a client makes a review through the Better Business Bureau, it is a verified client. They verify that it is in fact a client of Ignite Fundings. And whether it's a good review or a bad review, positive, negative, it doesn't matter. It's going up there because the Better Business Bureau wants people to see what is being said about this type of investment, the company, myself, any other employee that's working here. And so I would encourage you to do your due diligence through the Better Business Bureau and really get a feel for what people say about these investments and the company itself, and for any company that you're looking at investing in. And if you can't find a website that's transparent, I'd run away. If they're hiding stuff on their website and they don't want you to see it, there's a reason. So definitely, I agree 100%. Do your due diligence.
Wholeheartedly agree there. These are your tax sheltered investment dollars, people. Protect them, do your homework. Self-directed IRA world, it's an entrepreneur's world, but that just means that there's a little bit of homework. But what comes of that, doing that little extra bit of homework, you're going to end up with a cash flowing investment inside of a tax sheltered IRA. You're going to supercharge that compounding interest like you would never be able to with the stock market. The trade-off, do a little extra homework and make sure that you're putting your money in a safe investment, right? NuView, we're not allowed to give that type of advice to you. We don't have opinions on your investments, whether they're good or they're bad. That power's in your hands. If you don't want to make those decisions for your investments, well, that's where financial advisors and, those stock market products come into play. But that shouldn't be a reason for you not to try to learn how to use a self-directed IRA, what options are available for you, and who's out there that's a good, reputable company or someone, maybe an individual that can at least, maybe they have an opportunity for you like Ignite, or maybe they can just handhold you a little bit through the process to make sure that you're gonna walk out on the other side of that investment whole, and at the very least whole, not investing in an unsecured note and somebody decides that they want to up and leave to Panama or across the Atlantic, and all of a sudden you're out several $1,000s, maybe more than that. It's not a good situation to be in. So I do want to get into some of the little more complicated questions, I suppose, that we've had come into our chat and Q&A for Dawn. First one we had come in was from Ed, and he asked, what is your limiting factor at this time? Do you have more investors or borrowers?
We try to balance as best we can. This past 2 years have been record years for Ignite funding. The amount of new investor money and accounts that have come in over the last 2 years has catapulted us into really doing more due diligence on additional borrowers. It's allowed us to increase the amount of lending that we're doing. But we have to kind of keep a balance of both. Keep in mind, we have an underwriting department that is always in the process of underwriting new loans, but he has to keep that balance of X amount of dollars are going to be paid off by loans this month. So we need places for that money to be deployed back into so our investors can keep earning steady fixed returns. We also know on a monthly basis about how much in new money and new clients are coming on board. And so we're tasked with trying to keep enough out on our website open and available to be funded with the payoffs as well as the new money that's coming in. And so over this last couple of years, we've brought on a couple of new borrowers that have proven to be amazing borrowers that we will continue lending to. If somebody defaults, obviously we're not going to ever lend to them again. They're out the door. See you later. We don't need to deal with you. But we're always in the process of looking for new borrowers. There's some borrowers that are very small for us. They might only need 5 to 10 million a year in lending, but there's other borrowers that might need, 100 million in a year in loans. And so we constantly are trying to balance that throughout the process of bringing on new clients and new borrowers. I haven't seen here, I've been here, like I said, 13 years in June, and I've only seen maybe twice in our history where we're kind of going, excuse me, Pat, our head underwriter, we need more loans because we have more money than you've put out loans for, and people are waiting to get reinvested. It's only happened, like I said, about twice in the 13 years I've been here. Otherwise, he's pretty good at keeping those loans coming and available for our investors to get into.
That's awesome. I love a liquid market, whatever it is. If you can keep things moving, that's always good, especially right now with inflation, how it is. Sitting in cash and doing nothing's not good. So
We've noticed
next,
quite a shift. We've noticed quite a shift over the last couple of years. You know, when pandemic hit, we didn't know what to expect, right? We didn't know if borrowers were going to default. We kind of were taking a step back going, holy heck, like everybody else in the world, what's going to happen? And there, because we were considered an essential business and the borrowers that we worked with were considered essential businesses, there wasn't a single hiccup. There wasn't a single late payment. There wasn't a default, and it actually got stronger. The market for us actually got stronger, and investors started saying to themselves, you know, I need to get out of the stock market, which is so volatile. I need to get into something that's going to give me some sort of, you know, tangible asset at the end of the day. And so real estate became a very, very big asset class that investors started looking at, whether they were going to buy real estate to rent or fix or flip, or whether they were going to invest in notes like this that were collateralized by the real estate. We saw a considerable amount of new clients coming to Ignite Funding for that reason. And if they were fix and flipping, once the market started getting too high to really be as profitable, they decided, you know what, I'll park my money over here at Ignite Funding in these notes. I'm getting 10% or more. Let's see what happens to the market, because they're short term. I can always pull out of them and get back into rehabbing. And what ended up happening is people said, the heck with this. I'll just stay in these notes because I know I'm getting steady fixed returns. It's not speculative as to what my return is going to be once I fix and flip and sell. So this became a very, very sexy product for investors to get that steady fixed return.
cool. Yeah, no, definitely. It's strange times we're in right now. So I did have a couple similar ones come through. So this one I'm going to make like a little three-pronged question. It's going to be simple,
Okay.
but what's the average length of the note? So the average, I guess, maturity date from when it starts, the average rate of return through Ignite, and then do you have any average like loan to value that you guys work
Yes.
with?
And very good questions, because I did not really touch on that. So yeah, average loan term here is about 15 months. So we write our loans on a 9-month term with an optional 9-month extension period. The option is for the borrower, not the investors. That gives the borrower the option to extend his loan. Think, if you will, subcontractors are slow because they're so bogged down right now. It takes a little bit longer to complete a project. They get to the 9 months. We don't want them to be in default. They have the option to pay a fee and extend that loan. So that would be 18 months. Generally, they're paying off within 15 on the average. We do also offer our borrowers a 9-month with 2 optional 9-month extension periods. But every investor will know what that term is before they ever commit to going on a loan. You know what the terms are. Average rate of return. We offer our investors the 10% as the minimum. In some of our loans, you're able to get an extra 0.5% increase if you invest 100,000 or more in one loan. I would not make that the reason I put 100,000 in one loan, just because I'm going to get an extra 0.5%. Just depends upon your risk tolerance. But I do know that a lot of investors would rather spread that risk. The average rate of return, probably about 10.21% on the average overall. Average amount that people are investing here at Ignite Funding is about 92,000. And the last part of your question was, repeat that to me again.
loan to value, if there's an
Loan to
average
value.
maximum.
Average loan to value. you're probably looking at about 67 to 69% loan to value. Our criteria for lending is to stay at 70% or below. I have a project out right now that's a 41% loan to value. Phenomenal project up in Windsor, Colorado. Nice low loan to value. But I've seen loan to values go as high as 96%. And if we're doing a 96% loan to value on a first trust deed, it's probably with a borrower that's been with us over a decade and has a solid track record with us for us to go that high. But every investor knows what those terms are. There's a fact sheet that goes out that stipulates all the terms of the loan that you can review prior to committing to going on a loan. And then once you actually are committed to going on a loan and we send out those electronic documents, there's a section within the disclosures on those documents that asks you if you want to receive information about the borrower, about the property, and about Ignite Funding, the broker on the loan. Mortgage lending division says you can opt in to receive it or you can waive the option to receive it. Our policy is if you are a lender on any one of these loans, we're sending you all that information regardless of whether you asked for it or not. It's just our veil of transparency. So all of that information would also come out to the investors prior to you being funded in the loan itself.
That's really cool. And I appreciate that, especially being somebody that's not super familiar with the procedures of what you guys do. So that aspect of what you do, the foreclosure portal that you were mentioning earlier, sounds like you guys do a lot, like I said, to just put everything out there, and not have that veil that's standing between the end client, the investor, and then what they're actually investing in. So that's very cool. Which actually brings me to this next question from John. I thought this one was kind of interesting. He asked, when the document is filed on the property, does it list Ignite Funding in the entirety, or does it list out all the fractional owners by their percentage of ownership?
So on an original funding, there's times, for example, there's times when we actually pre-fund a loan. We use our own line of credit. We want to meet that borrower's deadline for funding. We don't want to lose the opportunity to purchase the property. So there might be a deadline where we're going to pre-fund the loan. Then Ignite Funding, of course, or our line of credit would be listed on that deed of trust. If you're on the first recording, you're going to be listed. It's broken down by the titling of your account. So, if you're John Smith, with an IRA at NuView, it's going to be NuView Trust Company, Custodian, FBO, John Smith, IRA, and the account number. Actually, they don't put the account number on there because that's public record. But so it's going to be listed as it's titled and the percent that your principal is in the total loan amount. If you're not on the original recording, so say we pre-fund it and then we backfill it with investors as they come on board, we re-record the entire loan once we fill that loan up. And so in the process, you're being added to the Exhibit A. Each investor will be added to the Exhibit A, and then the final recording will come and we send out that full deed of trust, title policy, and promissory note for the investors. The Mortgage Lending Division of Nevada actually requires that an investor acknowledge the receipt of those instruments. And so when we email them out, we have to get an electronic confirmation signature saying that you, in fact, received those items from us. So that's one of the things that they audit us pretty heavily over. So we're pretty on top of things, making sure that we get that acknowledgement and that you know that you've received those instruments that collateralize you on that piece of property.
Yeah, absolutely. And the way I interpreted that is, regardless of whether they were, the IRA was on the original recording or not, regardless, it's still, it still kind of gets processed as a note. It's not like, since you guys at Ignite, you funded ahead of time that, say a NuView client, invests after the original recording. It's not like they're investing into an entity. You're still investing into a note, and which is just
Correct.
going to be re-recorded, like she said, with the Exhibit A, showing the new lenders on there essentially.
Correct.
Okay.
Correct. And if you're working with a custodian, then we're also sending those items to the custodian so that they can update, your account and make sure that they have the proper instruments on file to, ensure that if the IRS came in and audited, they'd be able to see, oh, yeah, I can see exactly what this is. And yes, it's a note that they're invested in. They're collateralized. Here's
Mhm.
here's all the instruments that we need to see. So we're pretty diligent about making sure those items. Actually, we built out our system over the last 3 years to make most of that automated so that we wouldn't have, the challenge of somebody doesn't receive it. It's
Mhm.
pretty much just automated. Once certain things happen, a button's clicked, those items get sent out to the
Gets sent to
investor.
your email, gets sent to your
Yeah.
physical address, you get a text message, a phone call, like, you got it.
Yeah.
No, it's
Yeah,
good.
for
Definitely covering
sure.
all the bases. And of course, at NuView, we highly, highly appreciate that, on our end. More stuff that we can be provided with to paint the most complete picture. That's what we like. John did have a second part to his question too. Um, how quickly, on average, is Ignite, in the position that it is, able to foreclose and ultimately take back possession of a home in default?
Any property that goes into default, it depends upon the state that they're in. So each state
Okay.
has its own rules and regulations and the process to foreclose. Some states, once you file a notice of default, there's a 120-day curing period that the borrower has the ability to bring his loan current. Some states, it's 90 days. Um, for the most part, you're going to see about an average of 120 days before we can get that property back through foreclosure. Once we get the property back, we actually form an LLC that the investors become the members of the LLC. Ignite funding through our loan servicing agreement that you see in every set of documents you'll sign for an investment. The loan servicing agreements articles stipulate Ignite Funding will become the manager of the LLC. Now, the investors can all vote collectively and remove Ignite Funding. That's an option that you have. I don't know why anybody would do that, because you would want somebody that's working on your behalf, putting money out on your behalf so you don't have to, but you never know, right? But we would form an LLC. The investors become the members of the LLC. And the same thing applies with voting. We want the 51% majority vote from those members of the LLC. The property's titled in the LLC, so then they become the shared owners of that piece of property. Once that property is sold, if there's, capital gains, you're going to be distributing the capital gains on the back end amongst the investors based on the percent your principal represents in the total loan amount. And if there were any losses, it's done the same way. So it doesn't matter if you have, 30% ownership, you're not going to get paid off any faster than somebody who has 0.001% ownership because they, invested the minimum. Everybody gets paid off at the same time. Um, and so, we're processing and accruing all of that back owed interest and fees that we could collect from the borrower from the time of the default all the way through the resolution.
The LLC part kind of threw me for a loop there, but it makes sense, right? And it's curious from a self-directed IRA processing standpoint. And I don't want any NuView clients out there to be turned off by that aspect of the foreclosure process, because it might sound like it makes things complicated, but as far as I'm concerned, on all our end, we can do an asset exchange for you, basically replace the note investment with the LLC investment, and so your IRA is still going to have the tax benefits, even if that type of situation were to occur. It's a couple button clicks on our end. We'll probably need some documentation and some written authorization from you to make that change. But just know that there's ways to make these things happen. Self-directed IRAs, they get a little bit complicated, but there's ways to accomplish what you need to. Maybe it's a 3-step process, maybe it's a 2, maybe it's a 10, but more often than not, there's always a way to figure these things out. So I do want to cut the questions there just because we are running a little bit out of time. If anybody had any questions that were not answered, or they were maybe specific to Ignite funding and what they do, please direct those questions at Dawn. If it's something that's on the IRA side of things, we're happy to help answer any questions you've got. We'll have some contact information towards the end of these slides as well. First and foremost, though, we are coming to the close of March. And what that means is our monthly promotion is coming to a close as well. For March, we are waiving the account establishment fee of $50 and applying a $50 fee credit to your account. So you can effectively get started with the discount, and we try to make it as easy as you can for you to get started, right? The first step is always the hardest, just like Don was talking about. You got to ride the bike once, and you got to ideally not fall off it to learn how to ride the bike afterwards. But that's the process. You get your feet wet, you do it once, rinse and repeat, and it's familiar from that point forward. So getting past step 1, though, establish your NuView self-directed IRA. You can't invest tax sheltered without one of them, or an HSA, ESA, 401k. After that, you get it funded, whether you're moving money over from another tax sheltered investment vehicle or you're making a yearly contribution. And then your next step is to, find your investment. If that's Dawn, great. Just make sure you do your due diligence. Make sure it makes sense for you. If it's a different type of alternative asset, we can do those as well. Like I said, only 2 things you can't are life insurance contracts and collectibles. And if you do have any questions, we're always here to help. You can email us at iraspecialist@nuvviewtrust.com. Like I said, Don's email will be a great place if you have any specific questions about Ignite funding. This presentation as a whole has been recorded. We'll be sending that out to anybody that registered previously. It also lives forever on our Facebook page, which will be available right after this webinar ends today. And then in about 2 days, once our video guy Clay has a chance to clean it up, it'll also go on our YouTube channel as well. So you can get her contact information again through there, review some of the slides if something maybe wasn't clear the first time through. And then ultimately just get on your way to self-directing. That's the power of compounding interest, is starting yesterday. So you'll see a fancy little QR code there. Scan that and you'll stay up to date with NuView. It'll bring you to our educational resources page, our blog, basically anything NuView, any live events that we have going on. So live events, Don, we're going to be calling on you for our next annual investor retreat. I hope you had a good enough time at the first one because everybody loved your presentation, and
it was great.
Yeah, we'd be happy to have you back for the next one. So we'll keep you up to date on that. And everybody else, stay up to date this way. We'll make sure to have that on our Facebook, LinkedIn. As things come up, as we get things booked, we'll make sure to let you know when our next live events will be. And that is it. Dawn, thank you so much for hanging out today. I know I'm a little bit of a newbie when it comes to investing. I know the IRA side real well, but it's people like you that, make this journey to tax-free investing, tax-sheltered investing, building a legacy a lot easier because, it's a networking game in the self-directed IRA world. So just want to let you know that I appreciate you and what you guys do. And thank you for coming on today.
Well, we appreciate you as well. And I appreciate the opportunity to share this with all those that attended. And if anybody has any questions, please reach out to me. That the only way you get an education is if you ask for it. So I'm looking forward to talking with anybody that attended, and we'll move on from there.
Awesome. Thank you, Don. Everybody, we'll see you
Thank
next
you.
week.